welcome to this very special show, Election 2019 State of the Markets, our Fund Manager Special. We are here live from the NSE and we have a whole host of fund managers to tell us how to approach the markets in the run-up to the big election. Anuj, interesting times ahead. Interesting times ahead.
The last 5 years have been very good for the market. I think for the first time in history that the mutual fund flows may have outpaced the FII inflows, and that's been the key part of this market, the domestic liquidity. And just one thing, Sonia, even though the market's base case is of the current dispensation coming back and the market's rallied on account of that, the feedback we have is the India story is intact, and the kind of reforms that have taken place over the last 5 years should hold the market in good stead. But we have our guest joining us. In fact, it's who's who of the mutual fund market. We have to my left, of course, Sunil Sunghania, founder of Abacus Asset Management. To his left, Navneet Munot, CIO of SBI Mutual Fund. To his left, Nilesh Shah, MD of Kotak Mutual Fund, and to his left, of course, we have Mahesh Patil, Co-Chief Investment Officer of Aditya Birla Sun Life AMC. Gentlemen, thanks a lot for joining us. Nilesh, let me come to you first. It's been a dream run for the market. In between, we had a brief hiatus, but the market's back to all-time highs. The mutual fund flows have been stunning, and the heartening aspect was that when the market went through that crunching bear phase, the mutual fund inflows didn't really slow down. There was not too much of a redemption pressure. You think this is a bit of an evolving of Indian retail investor, and do you see that continuing post the election as well?
Definitely. Credit should go to the distributors who did handholding of all the investors during this time. We did see much higher seizure of SIPs on a direct side compared to SIPs sold by distributors. We also saw more redemptions on direct investments compared to investments brought by distributors. So somewhere there is this 100,000 plus feet on the street which are talking to investors, talking to retailers, giving them shoulder to cry upon when markets are down. Yeah. And that handholding has resulted into tenacity of this flow. My presumption is that this flow should continue.
Okay, the presumption is that the flow should continue. We've actually done a little bit of an analysis on how the markets have fared in the last 3 terms. So if you look at between May 2014 to the present situation, it's about a 10% compounded annual growth rate that we've seen in the market over the 5 years. May 2009 to 14 is a 10% growth rate, and before that, May 2004 to 2009 was a 25% growth rate. Sunil, coming to you, does this election have a potential to derail the market either way, or do you think it's going to be a non-event from a market standpoint?
See, as you rightly pointed out, that last 3 terms we have had varied, I would say, results from the elections. Ultimately, on the day of the election results, markets have swung very widely, but over a period of 2, 3, 5 years, I think the returns are just mirroring the GDP growth. So yes, on the day of the elections, depending on what surprises the elections throw up, there's going to be definitely a knee-jerk reaction. But I think history has proven over the last 9, 10 terms that the markets are, behaving in sync with what the GDP growth is. So I would say that the day of the elections might be up and down, but eventually it's the economic cycle which takes precedence. Obviously, the market wants a particular party to win, so that would be a near-term sort of a kicker. But I think over a period of time, you have to take into account a 7-8% GDP growth, a 4% nominal growth. So the broad market should grow at 11-12%.
Navneet, do you agree with that view? On election day, 1 week after election, 1 month after election, it's a different case altogether. Of course, post 2004, we had down circuit in the market. After 2009, we had an up circuit in the market. And then the market the returns have been pretty much, as Sunil said, on a linear manner, tracking the GDP growth or the earnings growth. You think 2024 market would be where it should be regardless of who comes to the power, or is it going to make too much difference if Mr. Modi comes back or not?
So Sunil said that market definitely expects a certain leadership and a certain government. Having said that, if you look at the history over the last 25 years, since 1991 when we started the liberalization, India has been growing at 7%. You add like so far the inflation has been higher and nominal GDP growth of 12-13%. Corporate profits have grown at 14-15%, and market has delivered exactly the same return, around 15 or 16%. An interesting aspect, several times when we look at the stock market return in a particular regime, we also forego maybe something may have happened before that or after that, because markets are forward looking.
Yes.
So if I compare the 2003 to 8 period where economy grew at 10%, 9%, and markets delivered phenomenal returns, 2 or 3 things very briefly I'll mention. We had substantial investments in road, telecom and electricity. Something similar has happened this time. We had significant decline in inflation, which led to lower interest rate regime in India from double-digit rates to 5-6%. Something similar is likely to happen because inflation has come down. But a significant cleaning of the bank's balance sheet. Exactly same thing has happened. Over the next few years, banks are prepared for a new credit cycle. And then the capital markets helped you. And that's when the corporate India could raise money, both in the equity and the debt market. And then we had a good period. The only difference this time is the global environment may not be as bullish or as supportive as we had in 2004 to 8. But otherwise, if I look at next 5 years, I think the structural growth story continues and cyclical upturn. We are going through a cyclical slowdown today. Nobody expected this kind of cyclical slowdown, but I think the cyclical upturn is likely to come from second half of this year.
Okay, so cyclical upturn from the second half of the year. Manish, I'll come to you in a bit, but before that, Nilesh, on a lighter note, you know, the last time we did a show here, it was during Diwali, and you said that you're not allowed into Diwali pujas, you're told to stand outside because the sentiment is so bad. Has the sentiment picked up since then, or because of the issues in the debt market, now you're still standing outside?
The debt market issues are non-existent. It is more the perceptions than the reality. We are repaying all our investors. Majority of the money which is due on the FMP, only a small person is retained, and we think it is in the interest of unit holders. So now during Diwali Puja, I hope I will be admitted.
No, but you know, Nilesh, just to put one more point here, is there a bit of a spillover risk now for debt mutual funds because of what has happened? I take your point that you are paying, but this is creating some kind of uncertainty. This whole Z issue, ITNL issue, how much of this is going to come back? Is this going to create one more round of liquidity issue, especially around debt funds?
Anuj, the liquidity issue originates from the systematic liquidity, never from market liquidity. If there is rain, then there will be water in the lake. If there is no rain, there is no water in the lake. So lake's water is dependent upon the rain. If there is systematic liquidity surplus, markets will be liquid. If the systematic liquidity is deficiency, then markets will be illiquid. Your FX interventions, your currency in circulation increase takes away liquidity. That is compensated by open market operations. Now, if that amount is negative, the markets will be illiquid because there is no systematic liquidity. Second thing is related to credit side. Now, 90-95% of mutual fund assets are onto funds which are AAA rated. Now, of course, within AAA, sometimes ILFS could happen, but ILFS was held by 6 out of 44 mutual funds, not by all 44 mutual funds. Majority of mutual fund also had ILFS exposure in their credit risk funds, not necessarily in non-credit risk funds. Now, in credit risk funds, you are bound to take credit risk, and it might result into some delay, some defaults. But rest of the funds, like bond funds, gilt funds, short-term funds, liquid funds, there the credit quality is reasonably superior.
No, just to wrap up this conversation, I mean, of course, we'll move on, but just to wrap up, since this is the hot topic right now, do you think the industry itself could rethink this whole loan against shares issue? And, do you think fund flows into FMPs could slow down because of, the concerns that there are?
I don't think so. Industry should stop loan against shares because it is the most secured form of investment. There has been one delay at loan against shares of Z, but against that there has been 5 repayments or prepayments. Imami, Apollo Hospital, Future Retail, Bajaj Corp, and Bharat Forge. All these promoters have prepaid their loan against shares or repaid their loan against shares. Now you are getting security which is reasonably good, and on which you are getting interest rate which is reasonably good. Till now, mutual funds haven't lost 1 naya paisa on any loan against shares transaction. Just because there is a little bit of delay, why should we kill the golden goose?
Fair enough. Let's move on now and discuss some other topics. Mahesh, there's one argument which says that the stock market is not reflecting perhaps the real pain in the economy. I mean, I don't subscribe to that view, but there are people saying that look at auto sales, for example, and auto stocks have been in a sort of a bear market, though we've started to see some bit of rally over there. Do you think there's a bit of a disconnect between the market and the real economy numbers, or to your mind there's no disconnect?
See, in the near term, okay, we have seen some kind of a slowdown in this quarter, especially because of the tightness which was there in the credit market. That probably led to some consumption slowdown. But I don't think, I mean, what we've seen in the recent past, that weakness is sustainable. I think you should see things recovering. Market is always slightly forward-looking. Market doesn't really, I mean, to some extent discount in the near term, but it's always forward-looking. So I think expectations are that India's growth rate next year, okay, will be tad higher than what we have seen in the last fiscal year. This is on the back of a scenario where we are seeing the global growth actually has seen downgrades to earnings, right? I mean, GDP growth has been downgraded by around 20 to 30 basis points or so. So I think we are expecting a mild recovery. Obviously, we are not in a phase where you will see a big cyclical upturn. I would agree, as Navneet said, we are seeing a cyclical recovery, but it's going to be a slow and gradual recovery. But definitely we are seeing an improvement. All the liquidity, okay, which is coming back into the system, even the budget, okay, which has given a kind of indirect stimulus, right? You will see the benefit of that flowing through as the money moves in the hands of the consumers. I think you should see recovery, especially on the retail and consumption side. So I would say that near term there has been some kind of a headwind, and we would see probably downgrade to earnings in this quarter. But by and large, I think the trend, what we see in the economy and the earnings growth is looking much better than what it was last year. And market is clearly tracking that expectation.
All right. Sunil, in fact, let me extend that point. 3 years back, the poster boys of Indian bull market were Maruti and Eicher Motors. You had Eicher Motors, which was, a 10-bagger every 8 years. You had a Maruti from 150, 200 rupee issue price going all the way up to 10,000. What's gone wrong here, or is it sort of presenting a buying of? Is it cyclical slowdown, or is it some kind of structural change the market's going through?
See, frankly, I think the characteristic of the equity markets globally have changed. So I don't subscribe to the theory that just buy and forget stocks. You mentioned Eicher. Last 10 years have been phenomenal for Eicher. But you look at the 10 years before that, it was one of the most disastrous stocks. Nothing was working for them. They had tractors, they sold off the tractor, they had a JV, and so on and so forth. Similarly, I think what has happened over the last 10 years, because of a multiplicity of reasons, other sectors not doing well, risk aversion, balance sheet issues, stress issues, a lot of money has gone into the so-called clean or predictable stocks. And I think we have started to give disproportionate multiples to that category of stocks. Frankly, I don't, subscribe to the theory that buy stocks at any price just because they appear to be, clean and they have done well over the last few years. If you even look at Hindustan Lever, last 10 years have been phenomenally well. Before that, the previous 10 years was a disaster. Reliance has performed for the last 3 years. 7, 8 years before that, Reliance was a negative return stocks over a 7, 8 year period. So I think dynamics have changed, and as an investor you have to look at what is there already in the price. And I think these stocks were clearly trading at very high PE multiple. So the slightest of slowdown has brought the PE down. It's not they are going to degrow, but they're going to grow much lower than what the market was expecting, and therefore the PE multiples have come down.
Okay. Navneet, just come in on that one point that Sunil made, where he said that, elections don't really matter. At the end of the day, the genesis of every bull market is an economic recovery and earnings recovery, more importantly. Are we at the cusp of a big earnings recovery, and what are you expecting both in Q4 as well as in FY20?
So stock price is nothing but the slave of the earning power of the underlying company. I mean, all of us keep repeating that every day. Over the last few years, surely the earnings growth has not been very broad-based. it has been concentrated into few names, few sectors. You talked about some of the companies which showed phenomenal profit growth. I think from here on, if we expect a cyclical recovery in the economy and over the next couple of years, a more broad-based recovery, it should also get reflected in broad-based earnings growth. I mean, just one example, the corporate banks or the corporate lenders which have dragged down the overall profitability of Nifty, or you look at any index, and over the next couple of years, as the pressure from the provisioning comes down and you get back to a normalized growth, I mean, they can impact the overall profit growth of corporate India. And there are a couple of other sectors. We haven't seen an investment cycle for a very, very long time. We expect an investment recovery to happen. That will also drive growth in a couple of sectors. There is, as of now, challenge on the consumption side, which has actually led the overall earnings growth in the last few years. We expect moderation in that, but I think from most of the other sectors which haven't seen the earnings growth are likely to witness that over the next few years.
All right, gentlemen, stay on. We need to take a short commercial break, but we'll be back and discuss many more themes as we are in for the biggest electoral exercise in the world, India Votes 2019. Nilesh, let's talk about the areas of reforms where you think the government gets full marks, the areas where you think the government gets less than 5, and they should have done better.
So the area of reforms or work where government has done a reasonably good job or better than expected job is basically infrastructure creation. We have been doing it at a fast pace. It's related to fiscal prudence. We have brought down fiscal deficit from 4.5 to 3.5. Third, where this government has done a great job is improving tax compliance and laying the foundation for a better tax compliance with introduction of goods and services tax. One area where I think government hasn't done any job at all is trade deficit with China. You look at US, President Trump morning, afternoon, evening fights with China on trade deficit. Our trade deficit with China is higher as a percentage of GDP than America, and we are allowing China to walk over us. This dumping by Chinese manufacturers Chinese goods has really impacted India's manufacturing capability. There are certain items which we have to import from China, but when a Kanjivaram silk saree comes made in China, when Amba Mata Murti comes made in China, when Ganeshji Murti with Chinese eye comes from made in China, I think we need to act.
Okay, they know what they're doing, right? The Chinese at least know how to market their products for sure. But Navneet, you were laughing. If you had to rate the government on a scale of 1 to 10 in various sectors, whether it's power, infrastructure, healthcare, what would your rating be? And what's the biggest miss that you've seen from this government and which the next government can work on?
So reforms, I mean, most of the reforms, you go back in history in 91, they have been incremental in nature. Over the last few years, we have seen significant reforms which are growth enhancing, which are productivity enhancing, which are for long-term macroeconomic stability. Talked about GST, IBC, RERA, your monetary policy committee framework, so on and so forth. But at the same time, there are a couple of other things that we need to do over a longer period to ensure that we get the full benefit. And those are more on the administrative reforms, on the judicial reforms, on one of the great things that has happened in terms of macro is lower inflation, but that has brought down incomes of 500 people on agriculture. How do you create jobs for those 500 people? And I would say we have made significant progress on defense security of India. Now we have made significant progress on food security of India. The next thing we need to do is energy security of India. We are still so vulnerable on the oil prices, and I hope that some of these things become the agenda for the next government.
Mahesh, what would top your wish list for the next government? Whichever government comes to power, what would be top 3 or 4 things from economist's point of view and from market's point of view?
Yeah, I think clearly, this government, it talked about creating manufacturing was a big, Make in India was a big theme which was there, and which could have created some kind of taken care of the trade deficit as Nilesh was talking about, and creating jobs. Because that is going to be a key challenge going problem, because of the reforms what we have seen, there is an unemployment, which is bound to happen in certain sectors. So we need to create that kind of an impetus. I think we have done well in terms of ease of doing business, a lot of bottlenecks which were there on the infrastructure side, logistics side. We are trying to address that, dedicated freight corridor which will come in, port infrastructure. But I think having a policy which is conducive so that we can attract capital and create large manufacturing base we are slightly behind the curve now because world is now moving away from manufacturing with automation coming in. But we need to identify certain areas and sectors, okay, where we have competencies, and that I think because service-led growth we have seen to a large extent, I think we need some amount of growth coming in from the manufacturing side. And that's an area where I think the foundation has been led, I think, in terms certain other reforms on the labor side, we need to address that. And though it's a lot of states are involved in that, but if that is taken care of, I think then you can see a much more sustainable growth for India going forward.
Okay, so since they've listed all the hits and the misses, why don't you rate it on a scale of 1 to 10? How much would you give the government?
I would say somewhere around 7. Okay. And I would agree with Mahesh that, on the manufacturing side, I think lots needs to be done. So it's a fact that job creation has been a challenge, and the challenge is increasing every day. We individually also get so many requests from our friends and relatives for their kids to be placed somewhere, whether it's be financial services or in any other aspects. So I think job creation is going to be a big issue, and that is where increase in manufacturing activity, increase in business activity would be of I would say the biggest importance. Obviously, we have had some issues with demonetization and GST stalling that, but wholeheartedly that should be the key factor. And it will tackle the Chinese issue, it will tackle a lot of other things, but that push where the Indian entrepreneur feels comfortable in borrowing, gets the money from the bank, gets the equity to invest, and also has that sort of support that yes, you can take the risk and be an entrepreneur.
So if there are so many of these issues, job creation, the China factor that he spoke about, dumping of cheaper products, infrastructure push is not happening, investments at a 7-year low, what gives you the confidence that earnings will return to double digit in FY20?
See, I think this has been a period of a lot of issues which were pending to be done, having been done. So, whether it was GST, or whether it was increase in tax compliance, I think these are all near-term deterrents for growth. I think the banking issue was, I would say, the biggest issue which was stalling growth, because suddenly, banks had no capital. So first the old problems had to be resolved, and last 2-3 years has gone into resolving that problem. Navneet mentioned now the banks are having a clean slate. They have recoveries which are going to happen. The steel sector has already been sorted out. The way the power demand is going and the fact that no capacity has been created over the last 3-4 years also makes us believe that next 2-3 years, even the power sector will have a lot of, sort of incremental profit visible, and therefore the stalled projects or, the sick companies will be sold, and the banks would have enough capital to lend. In fact, I would differ with Navneet. I would say that even global capital is now looking again at moving outside of US. Last 4-5 years, US currency was constantly appreciating. There was no reason for any investor in the US to be shifting money away from the US. And that thing has changed over the last 3-4 months. I think this rally which we are seeing and the big, I would say the spurt of foreign inflows is a result of interest rate in US now looking at softening, and therefore the dollar is now weakening at the margin. So I think these are combinations which would lead to a lot of sectors starting to turn. Obviously corporate banks is one sector, but other sectors which are infrastructure related, whether it is, the construction companies which are doing well, capex companies or the capital expenditure companies in September and December reported fairly good margins in spite of, not such a buoyant environment. And I think consumption in India at 10-12% growth looks to be pretty visible. So
I mentioned the same that I think both the nominal and real rates are attractive, so should attract more flows from the rest of the world.
Okay. Navneet, Sunil mentioned that the texture of the market has changed. You can't just look at, buy and forget. Of course, now we're in a market where every Thursday there's an expiry and 95% volumes are getting generated out of that. And everyone is asking what to buy in the morning and sell by afternoon. But, leaving that aside, for equity investors, what's going to be the big theme for next 5 years? You always back big themes. What's the next big theme for next 5 years? Every bull market is a different leader.
So ultimately they'll remain more or less same, right? So India from $2,000 per capita will become maybe $4,000 over the next few years. So a lot of consumer companies will do well. I mean, a small example within the financials, we had few banks, but you see the expansion of the financial sector. Large insurance companies getting listed both on the life side and the general side, and then several of the smaller finance banks. The variety of other financial services companies that have come to the market. If we are successful in this medical insurance, and increase the overall healthcare spending, there would be a lot of opportunities in the healthcare side. On the industrial side, as I said, that I think we have seen the bottom on the investment cycle. This is going to get revived, and I think it's going to happen sooner than most of the other people expect, with a cleaning up of the bank's balance sheet, with a better corporate India balance sheet, and the capacity utilization increasing over the next few years. I think we are going to embark on another investment cycle. India is a structural growth story, so we'll buy stocks from the industrial side, we'll buy from the consumer side, and there will be few opportunities on the export side, which has been one of the big pain points for India, that other than few bright spots like IT or maybe something in the autos or chemicals or maybe a little bit of light industrials, we have not been really able to expand the export side. I hope that in next 3-5 years that changes.
Okay, then finally, before we end the show, Nilesh, last word always from your end. The Nifty has already given us, what, about 8% returns this year. Where do you see it by the end of the year, whichever way the elections go?
So for Nifty to provide better return, we require a couple of things. The next government should pursue the path of fiscal prudence, because better macros will give higher valuation. Second, we have to tackle deficit with China. You can't hit your manufacturing base for someone else's. Third, there has to be better liquidity for credit creation. All the investments will happen only if there is better liquidity. Fourth, the real interest rates have to normalize. There are very few countries in the world where entrepreneurs pay nominal interest rate as high as entrepreneurs are paying real interest rates in India. And fifth, the transmission of credit should happen. Today we have a scenario where in FY18, 1/3 of credit was provided by PSU banks, 1/3 by private banks, 1/3 by NBFC. Within PSU banks, banks are under PCA, so credit is not being extended as easily, or it is going to have a AAA rated segment. In the NBFC, courtesy ILFS default and subsequent tightness, there has been a slowdown. So effectively, the entire engine of economy is credit supported by private sector banks and few select PSU banks. We can't run an automobile with just 2 wheels moving. We need all 4 wheels to move. So we need to improve transmission of credit. If these 5 things happen, then hopefully Nifty return, Sensex return will be much higher in the years to come than the past.
20,000 Nifty?
Don't ask me the year yet.
Okay. Mahesh, what are the risk factors, and do you see Nifty 20,000 by the next election? I mean, it's not that fast.
I mean, it's possible. The risk factor, as I said, is, as Nilesh mentioned, I think the fiscal side, definitely there is a challenge which is there, right? I mean, this government initially had the liberty where you got a lot of fiscal space, oil prices came down, you could spend in infrastructure, and that could actually give some, while other private sector was lagging, government spending was high, which sustained the economic growth at a lower rate. So I think that, how to manage the fiscal side, I think is important, and how the tax revenues, because GST implementation has happened, its taxation hasn't been to that extent. So what the buoyancy we see in tax is important, and oil still remains, because when fiscal is tight and if oil prices zoom up, right, again you will have a problem both on the CAD side, also in terms of government's ability to spend. So I think those are 2 risks which one would mention, but I think I would agree that assuming that there is continuity in terms of the policy of the current government, I think we have the foundation laid down, okay, and clearly earnings growth, while there could be some downgrade, but clearly this is the year where you will see the earnings growth to be the best in the last 5 years. So given that, I think market should touch new highs. What level it will get is anybody's call.
Okay, well, that's quite an optimistic view coming in. So I think our consensus view is that there are some hits, some misses in this market from the government's point of view, and a 7 on 10 is what Sunil has given the government its rating on various sectors' performances. Well, with that, it is curtains down on this very special edition of the Mutual Fund Cafe. Thanks so much for watching.